Okay, let's get started. So what I want to do today is review a exam style question. So I have assigned, what question was it? QS, not QS, sorry. Get I have my dual screen set up and it's just awkward. Okay, so if you go to A 2014 on page 1472, this is a typical question that you'll find on an exam. Why? Because it takes into consideration your basic EPS and then gets into the what if scenarios of the diluted EPS. Okay. So again, I use this template. If you use this template, you pretty much can't go wrong. Okay. So again, if you're comparing to what I just wrote to up on the board, compare that to your answer key 20 assignment 2014. Okay, that's page or A 2014 on page 1472. Again, it encompasses both basic and diluted EPS. So you'll start with three columns. Earnings available to the common shareholder. Okay, that's your net income minus the preferred dividend. Then you'll have your weighted number of outstanding common shares, and then you'll get your EPS. So let's read this scenario first of all. On January 1st, 2016, let's say, the capital structure consisted of the following. 450,000 common shares issued for 5.75 million were outstanding. Okay, so right off the bat, I'm going to need to know that 450. Why? Because it's going to figure into our weighted average number of shares. Next part, they have 50,000 preferred shares bearing cumulative dividend rights of $5 per share. Okay, so we know that the preferred dividends on a yearly basis will pay out 250,000. That's important. Why? Because you got to remember, what's that EPS calculation? Net income minus your preferred dividend divided by your weighted average of common shares. Okay. So right off the bat, we know that this is going to be minus 250. Okay. We'll get into the convertible bonds later, okay, because that's dilutive. But right now, we want to figure out our basic EPS, because that's the starting point. Now, we have outstanding options. Fine, that's a diluted mechanism. On September 30th, they issue an additional 100,000 common shares for 1.5 million cash. Very important. So now, and then we also know they have earnings of 1.5 million for the end of the year with a tax rate of 25%. Okay, so our net income for the year is $1.5 million. Okay. Again, we can just fill in the blanks as we go along now. We know that the preferred dividend is $250. As a result, the total earnings available to the common shareholder are how much? Well, $1,250,000. So we've satisfied the top number, okay, to calculate our basic EPS calculation. 1,500,000 minus the 250, okay, gives us 1,250,000. Okay. Now, from there we got to figure out the weighted average number of common shares outstanding. So again, we knew that from January 1st to September 31st, 450,000 shares were issued and outstanding. So that's for 9 months. Okay. So 450 times 9/12, that's going to be 337,500. Okay. Now, on September 30th, they issue another 100,000 shares. So for a 3-month period, they actually have 550,000 shares outstanding, okay, on a proportionate basis. Okay, that's for only 3 months. So the weighted average, again, 137,500. You add those two together, we get a weighted average number of common shares outstanding of 475. $1,250,000 divided by 4 475,000 is an EPS of 263. If we wanted to put that into our formula, again, what is it? 1,500,000 minus 250, which is your preferred dividend, okay, minus your weighted average number of shares outstanding, common shares, 475, giving us 263. Okay, this is our starting point. Again, like I say, if you can do this question, you'll have no problem on the quiz and no problem on the final exam. So again, what this has done is it's given us our basic EPS calculation. Okay. So from there, we've got to go and we've got to figure out, okay, well, what's the dilutive effects now? Okay. So the information that we need to carry forward from this is our earnings available to the common shareholder, our weighted number of shares outstanding, common shares outstanding, and our basic EPS. Okay. So what I'm going to do is I'm going to put those numbers up here. Basic EPS. Sorry. 250, 475, and our basic EPS of 263. Okay. I should have used black marker, it looks like. I just wanted to signify the differences. And again, you can always reference the answer key if you need to. If I'm just showing the steps to do this. Let me rewrite this out here. One, 250, 475, and 263. Okay, so that again, that's our starting point. But what you would want to do is you'd want to lay it out as you see in the textbook. So again, this is kind of the end result of the first part of the question. Okay, calculating the basic EPS. So we've already calculated the basic EPS at 2.63. Now let's work on the diluted effects. Okay. Okay. So the first thing we're going to do is we always want to go look at the options. Okay. So, oh, Jesus, this is confusing. My screens are switched, so when I go this way, the mouse goes this way, and vice versa. Anyways, let's go look at our options. Okay. So it says here, 2,000 options. Oh, no, wrong one. We have outstanding options of 50,000 common shares at a price of $5 a share. Average market value of the common shares during the period was $20. So they're in the money, right? So let's take a look at this. How are we going to do this? So the shares that we're going to issue, shares issued, okay, in this case were 50,000 at $5. So 50,000. Now, again, when we do the diluted of EPS, we always bump it up to the beginning of the year. Okay, so we don't have to worry about weighted average. Now, also, okay, so we're going to issue 50,000 shares with the options, but how much are we going to buy back or retire? Well, remember, let's look at this calculation here. Okay. So 50,000 times 5 is 250,000. So what the company will do is they'll go sell these options to management for $5 a share. Okay, so now what's happened is they've issued another 50,000 shares. What the company is then going to do is with that 250, they're going to go and buy shares on the open market. Okay, so if the shares are currently trading on the open market at 20 bucks, okay, so they'll take the 250 cash divided by $20 per share, which is market value, and you get 12,500 shares that they can retire. Okay. So, again, the shares that were issued were 50,000 times 5. Okay, so that's the number of shares, 50,000. Then you'll take that number, which would be 250 divided by 20. So the net result is 37.5. Or no, it's not 37.5. What is it? 50 minus 12,500. It is 37.5. Okay. So you can do it this way, showing in and out. I would have just netted it out and put 37.5. However, do it how you want to do it. Okay. Now, from there, what do we have? Well, we now have, I'm just going to go erase this. Options 37,500. There's no effect on net income right now. Okay. Now let's go to look at the bonds. So this company has $1 million par value bonds of 5% convertible bonds. Each has $1,000 face value. Interest is payable on June 30th and December 31st of each year. Each $1,000 bond converts into 65 common shares at the option of the holder anytime before December 31st, 11th. Interest expense on the convertible bonds that should read $50,000. Okay. So let's go look at the bond. Okay. We're going to have shares issued, and interest avoided. Okay, well, what are these numbers going to be? First of all, let's look at how many shares we are going to issue. Okay. So we have $1 million of bonds. Now, each has $1,000 face value. And interest payable, okay, fine. Each $1,000 bond is convertible into 65 common shares. So what we almost got to do is we've got to take the 1 million divided by 1,000, which gives us 1 million divided by 1,000, gives us 1,000 units. Or actually gives us 1,000 $1,000 bonds. Okay. So from there, what we're going to do is, remember, it converts to, every unit converts into 65 common shares. Okay. So 1,000 times 65 is 65,000 common shares. So what that's telling us is we're going to convert $1 million of bonds, okay, into 65,000 common shares. So we're issuing another 65,000 common shares. Okay. Now you're going to see how over time this is getting diluted. Now we've got to remember another thing. Since we've converted the bond, potentially converted the bond into shares, we avoid paying interest. Okay. So in this case here, the interest expense was $50,000 a year. That's pre-tax. We need to figure out what is the after-tax expense that we're going to avoid. Okay, so $50,000, which is your yearly interest, times 1 minus 0.25, which is the tax rate. Okay, so 0.25 times 50,000. 0.75 times 50,000. That's 37,500. So we avoid paying interest of 37,500. So over time, what we're doing is we're reducing Okay. So what's happening here? It's actually not minus 37. We're saving 37,500 by not having to pay that out in interest. Okay. So again, now after we do each section, what we should do is we should recalculate our EPS. So I'm just going to erase this for a second. So after our bonds, there's no change. After the option, sorry, there's no change in the earnings available. So it's 1,250 divided by, in this case, and the options were net 37,500. So now it's up to 512,500. Okay. So again, carries out our EPS is going to drop down to 244. Now we'll go into the bonds. So we have our we'll have our interest avoided and our shares issued. So shares issued, interest avoided. Okay. So the shares that we're going to issue would be 65,000 shares. But we have a savings. Okay, we have a savings that we don't have to pay out interest of 37,500. So since we have a savings, we don't have to pay that out. We're going to add that savings to the basic EPS, to the earnings available to the common shareholder. Remember, that's after tax. So we add that up. Okay, we can see our EPS is still going to be reduced. So now we have earnings available to the common shareholder of 1,287,500. And we have outstanding shares of 65,000. Sorry, 65,000 plus the 512,500, which is a total of 55,77,500. Again, this divided by this is going to give us a new basic, a new diluted EPS of 223. So we have our bonds that we've converted. We have our options that we've converted. Now, is there anything to do with preferred shares? In this case, there is not. But let's just say that we had preferred shares that were convertible to common shares. The only thing that we would do there is we would have a savings on the, if there was a preferred share that was convertible, say, just say it's 1-to-1, okay? So in this case here, we'd have a savings on the preferred share, so we could add back that $250 of preferred dividends, okay? And then we would increase the number of preferred shares. So it goes 1 to 1. So we now have an extra 50,000 of common shares again, because they do a 1-for-1 conversion. Okay. So again, there are questions where they convert the preferred shares to common shares, but if you can do the diluted EPS with the option, the bonds, the bond conversion, and the preferred share conversion, you shouldn't have a problem on, like I say, on the quiz or on the exam related to this topic. Okay, so we're slowly wrapping up this chapter. Okay, so again, I'd like you to look at this today and tomorrow, and we'll go from there. We're kind of, I don't know, I find I'm going through the chapter pretty fast, not being in class. I'm finding it very difficult. I know you're finding it difficult as well, but we're just gonna have to work through it. The other classes, it's hard. Like auditing, it's one of those classes where I'm doing our best with it. It's a lot of just reading, and unless I'm there for you answering questions and diagramming things out on the board, I just find it tough. Same thing with corporate finance. Do the formulas again. For corporate finance, the exam is just going to be multiple choice. So again, what you may be missing out in class, the exam won't be as challenging as it necessarily would have been. So that's it for today. Have a good weekend, and I will see you on Monday. If you have any questions, please let me know.